Hello and welcome to PGurus channel. I'm your host Sri Iyer. Mutual funds, are they safe? Is your money safe there? To know a little bit more about it, let's talk to the expert, R. Balakrishnan. Bala, welcome to PGurus channel.
Thank you, Sri. Good to be with you.
Bala, you and I, we have talked about the state of the stock market. We have talked about markets. You've played some very significant roles in the formulation of some of the bodies. Perhaps you can, refresh our viewers a little bit about your work when you were still professionally involved in Mumbai and other places. You are the founder of some bodies, and then your read on what is happening with the mutual fund market now. Where do you think it is headed? Do you think India's stock market is stabilizing very soon, or is it already stabilized? What are your thoughts on that?
Well, I think let's start with the mutual funds.
Yeah.
I think the mutual funds what happened is in India, it's got too much of a tinge of investment banking into it.
Okay.
So instead of becoming a pure retail vehicle, it's become a vehicle for deal making. So there are unknown companies who want to raise money, and there are mutual funds which over time have become large in size. So they all now there is a race to kind of improve the yield so that my nose is a little ahead in the measuring tape, whatever. So what happens is you take risks which are not warranted. You think that I will buy some 10% of my money, I will put into a paper, which I can hold to maturity. I know this guy will repay. I take that call because I am the master of the universe. I know risk. I manage everything. I know every company. I know every promoter. So I keep doing that. When times are good, everything is fine because the best of companies today, if you are leveraged 3-1, if you take a finance company 3-1, 5-1, and you are also into a constant mismatch, and you never actually
could you explain to for our viewers' benefit what leverage means in this context?
Means if the shareholder money is X and you are borrowing 5X from the banking system or from whatever sources you can, so that is leverage. That is your own money plus outside money. Leverage or gearing, as we would like to call it.
So some dumb question, Bala. Why would the bank want to give 5 times the money that you have as assets of your customers?
See, the banks also are keen to employ, it is indirect lending for the banks. What they do is this guy is okay, he's lending to truck drivers, he's truck owners, he's lending to buy cars, he's going to do X, Y, Z. So he takes the risk and I am getting the money straight and he is willing to pay me a 1% more than Infosys or a Reliance or the best credit I have. So I'm happy to lend to him because that guy knows his business, he manages it, so he gives me. So all banks are happy to do that. Plus, not only banks they raise a lot of debt paper, which is either commercial paper or bonds, which can be 1 year to 3 years to 5 years, which are in demand or in good times from mutual funds, insurance companies, pension funds. They keep buying those things. And what happens is this guy sees the arbitrage between a short-term rates and a long-term rate. So he says, let me do a commercial paper of 90 days. Though my loans are to truck owners for 2 years and 3 years, I will constantly find buyers for my commercial paper. So, and I will save 1% interest compared to a debenture. So this is the kind of leverage which goes on.
Bala, I just want to break it down. Sometimes our viewers are not familiar with terms like arbitrage and commercial paper. Perhaps arbitrage is the difference in lending rates, right? Short term is usually high, long term is usually low. So short term could be 4, long term could be 2. So there's a 2%. That difference is what you call as arbitrage, right?
So let me put it this way.
Yeah.
I am lending money to somebody for 2 years. So now I am doing it with borrowed money. So logic says that I should have 2-year money with me so that I don't have a repayment pressure.
Right.
That when that money comes, I will give it back. I make this small difference. But now I get very smart. He says there is money available in the market for 30 days and 60 days at 2% less than what I can borrow for 2 years. So if I get that rate, I will make 2% extra over 2 years. So what I do is I issue 30-day paper, 60-day paper to that full amount. With that, I have funded this. On maturity, I know that my reputation is still good. There are enough buyers who will back me again. So I keep on rolling it over. So this is how a finance company operates, by doing what is called as an asset liability time mismatch.
Okay, everything is fine as long as market conditions are normal. That there is
Exactly.
business, that there is some rollover of money. However, you have taken a hammer to the market. You have completely brought it grounding to a halt.
No, I think the problem is just not that, Sri. I think this was something which is still manageable.
Okay.
But what happened is the mutual fund industry, instead of just financing the commercial paper and debt which was floated by companies, they became deal makers. They started doing promoter funding. They started doing real estate funding to builders. They started becoming an intermediary vehicle for intercorporate loans, which will violate the related party guidelines. So they did a lot of things, saying that ultimately these are people known to me, so on maturity I will roll over. If not fund A, fund B will buy. So 3, 4 fund get, and all for that extra percentage or two. So what happens is it became a vehicle for corporate money. So, and when panic steps in, corporate money just exits what is there in the mutual funds. So that creates a big hole. Now you got to go and sell something. Now, so far you continued with growing assets. You never had to sell anything in a distress. So now you find that you have to knock your NAV off. Now the corporate guy has taken the money out at the best possible NAV and gone. Now what you are left with is the retail investor and the uninformed investor, who is going to take all the knocks. So the first reform I would like to see, if I may, I'm probably jumping the gun, but I'm saying block all corporate money into retail funds, or create two separate things where you don't commingle assets and liabilities. Let retail be separate. Because if it was retail alone, there would be no panic. Believe me.
I have another question, Bala. See, when Yes Bank got into trouble, right? State Bank of India stepped in and they took, I think, 40% or something in that thereabouts equity into the Yes Bank. Now, if you look a little closer, there were State Bank of India based mutual funds or released. No, there were mutual funds issued by State Bank of India and I believe HDFC. The question for you is, why are the banks in the business of mutual funds?
Well, I think world over it's been like that, unfortunately. I think money is, and the pure mutual fund is only, I think, Franklin Templeton.
And that is closing now.
No, that's closing some schemes. I think let's be very clear. It is closing some schemes because, see, there was nothing wrong with the scheme. It was sold as a credit risk scheme. The people were told that this is the credit risk I am taking. And then every month you have the fact sheet with the list of borrowers, everything coming into you.
Okay.
So it is not that, see, and why do somebody comes in? Because they think they can make that 2% extra.
Right.
They have seen that over the last 5 years, this kind of a fund has delivered 1%, 2% more. And Mr. Kamath, who is the CIO, has done a splendid job that way. He understood risk and he said, this is the risk, I am selling it to you as a high risk product. So that was the thing. And now he says, because huge monies are going out, these papers do not find a buyer at reasonable price. So I had better close down the scheme, which means you wait till I liquidate all the assets over time and you will get your money back.
Well, it sort of sounds like caveat emptor, which is buyer beware, that when you are buying these funds, that there is a higher element of risk involved. I can live with that. That's fair enough. So in general, this move doesn't affect the other mutual funds, is what you're saying.
No, but what will happen is now everybody will be in a hurry to pull out money.
Knee-jerk reaction.
every mutual fund will want to have to sell something to meet that redemption. Now, the Reserve Bank has given a line of credit to all mutual funds saying that up to 25% of your assets you could borrow money. So, up to that, yes, you can fail. Beyond that, if the redemption pressure comes in, now the retail will never react like this if you can do. The problem is the mutual fund is packed with a lot of corporate money. Banks put money into liquid funds, do you know that, in a huge way? And then I will go and buy a bank CD. So the bank says I am growing my assets and liabilities both. So there's a lot of these kind of things which need to be stripped out of a mutual fund. For the retail, retail keep it simple. Don't let it get commingled with other investors.
Very, very interesting conversation, Bala. I did not know all these nuances about mutual funds. And I think this actually should make people feel a little bit better that, you need to really do a little bit of homework whenever you are part of any organization which is itself investing in mutual funds for you. Usually they are supposed to give you a choice of 5 or 6 funds, and you should do the work on those to find out which one suits your appetite best. Is that a right way of saying it, Bala?
I think so. See, I'll put it very, very bluntly in numbers also. In a bank deposit, you will get 6, 7, you used to get around 8%. Now it's probably coming lower. So, which means on that you would have to pay your taxes. You will get your after tax of 5 or 5.5. If you are a senior citizen, you could take interest up to some amount tax free. Now, the mutual fund invests in government paper or in private paper, which gives around the same rate of interest. The only thing which you are getting tempted by is the tax arbitrage, because after 3 years there is only long-term capital gains, so which is lower than the income tax rate. And people forget that if the mutual fund invests into that same paper which you can directly invest, and it charges you 1.5 to 2% interest, expenses plus management fee. And what is left is what you will get. So logically, it should be lower than what you can get directly.
So true. In fact, I made this mention 2 years ago when I was talking about my book called C Company in Mumbai. And I just said that any mutual fund at best can do 3-4% more than what you're getting from the bank. And so basically, you've just reaffirmed my, mota viewpoint. There can be nuances.
Other than tax, there is nothing. If the mutual funds are put into the tax bulk, means saying that they are also taxable entities, that industry gets closed.
Yes. Now, I have a different question. What is the status of the exchange-traded funds in India? Is there any ETF, like, for example, Nifty 50 ETF?
We have a lot of ETFs. I think they are doing well. The money is coming into that. And those are good developments. Except that we don't have a index which is stable enough. The index committee, in all its wisdom, keeps... Can you believe that the index today, 45% of the market is, the weight is finance companies and banks?
Yes, I know.
In the real economy, banks and finance companies are probably 15% of the economy, not more than that.
You see, there are some basic things that are wrong about India in terms of stock markets. You have 5,000 listed shares, only 150 are actively traded. And
we have a large OTC market. Accept that and live with that, saying that you move a lot of things, and we have a very fake F&O where the futures are settled in cash.
Hello?
A lot of speculation.
Hello?
Yeah.
Hello? Can you hear me? Yeah. You said we have a very shallow, I lost you. Just start from, we have a very shallow F&O or something like that.
Very shallow market. And as I said, 5,000, but maybe about 100 really liquid counted.
Right.
All the rest are really OTC stocks. I think we should live with that. We should not have too many derivatives on this market. Let it be a real market. And plus we have this huge industry of lending against shares, which distorts the IPOs totally. And Well, I think a lot of reforms are needed, but we want to do better than America. We want to do better than, but we forget that this side, probably the market cap is a little more than Apple's market cap.
Yes, yes, that's true. Very, very interesting conversation. And viewers, if you don't want to, let go of 1.5 to 2% of management fees and other funds that get tagged on to your, mutual fund investment, you should consider ETFs, exchange traded funds. Those have a really, really low load, which is the cost of running that fund, and that might be another option for you, because now you're going to start looking for every paisa that you can make, because you're going to save every paisa that you can. So there is a bigger thrust towards that. So I expect that ETFs and the interest in ETFs will go up. On a different conversation, we will talk to Bala about exchange traded funds, what to look for, what is the value, where do things stand, and so on and so forth. Thank you very much, Bala. It was the most interesting conversation.
Thank you, Sri. Thank you very much.